probably for 1 to 4 revision. The next 2 weeks, we'll have a next lecture directly on 7th June then. But you need to complete 12 and 14. Does it look possible? Chalega, yes, no? 12, 14 lectures with solving. 12, 14 is going to be a little bit tricky for you to understand in the first place. A little bit, not too much, to be very honest, but it's an important chapter. It will literally set your base for the entire CM2. So, but it's a very important lecture, to be very honest. So if you want to do that, it will give you time to basically cover it up in case you're not here and then give it out. Chalega? Fine? Okay, I'm fine. Who's there? What's the date? Thursday is around 22nd. Let's plan this for the next 2 weeks then. 1 to 4 and 12, 14 on 7th of June. Just to give you a brief idea about what 12 and 14 and what 1 to 4 is. 12 and 14, we are talking about derivatives. And pricing of derivatives in a discrete time. When I say derivatives I basically mean that a value derived from another asset. Okay. I'll just give you an example for this. For example, right now the MCX price of gold is 92,000. Right now, the MCX price of gold is 92,000. Okay. What I will do is I'll buy something known as a futures. Futures is a contract, okay, where you have to initially pay an amount, I would say 0 or some nominal amount, even if it's there. You pay an amount 0. Whatever the difference is after 3 months, you basically do that. For example, just giving a hypothetical example, 92,000. The futures contract is priced at 93,500. Okay, for example, okay, I'm just giving you a random example. It's priced at 93,500. So after 3 months, if the gold exceeds 93,500, for example, the gold price becomes 94,000, for example. Okay, so you'll get 500 rupees. It's like making a bet. For example, I'll just give you my position for last week. I took a short option, or I would say short position on IndusInd. IndusInd.
Share तो नहीं कर रहे ना?
Huh? Oh, sorry, I'm not sharing this screen. Yeah, wait 1 second. I'll just share it.
Okay.
So what did I do is I took a short position on IndusInd last week. IndusInd price at that time was around 780. Okay. The price on Friday around 11 o'clock in the morning was 750. So I basically earned 30 rupees by selling one IndusInd first and then buying it later. A futures or a forward contract works in a similar way, but there is an expiry to it. Okay. Usually in a market, futures have an expiry every month end. Okay. Forwards also has an expiry of every month end. It's similar to price of a future. So I would say share price and future price are similarly priced with a few difference based on what the expectation is. Okay. Futures price 93,500 hai, but current price is 92,000. What does it mean? It means that we are expecting 1,500 rupees to go up in the next month end, or maybe May end tak. We're expecting the price to go from 92 to 93,500. So it is already incorporated in that futures. Anything above or below is what you're going to make your money on. That's how your future contracts work. 90% of the cases, I would say your future contracts is 1% up and down with respect to your share price. Not a major jump. It's usually 1% up and down based on what the people are expecting over the next month end or however it is. If you're expecting something good results, obviously the future contracts would be lower price or higher price based on the circumstances. Forward is also similar way. Options, let me not get into the options or else it will get very confusing for you in the first place. But that's how your market works, right? It's not just one component. You can have multiple components in order to make or break money. Okay? It's not just buying your equity or selling your equity. There are a lot of options. In your CM2, we'll be studying something known as forwards. We'll be something known as futures. We'll be learning something known as call options, and we'll be learning something known as put options. Okay? These are the four basic things what you are going to learn across your CM2. You're going to do pricing in a discrete format. You're going to do pricing in a continuous format, both of these scenarios. But in reality, this is not it. There are a lot of other derivative products which is available in the market. Actually, these are the derivatives which are least traded in the market, to be very honest. The most traded is swaps. Usually, swaps exposure on a daily basis is around $60 trillion on a daily basis. Okay. The swap is the biggest market when it comes to the derivative products. Future, forwards, call, put are just the basic one of them. This is what we are going to study for CM2. We'll get into the level of details. I'll give you some examples around the same thing so that you can understand what is happening. People call these options as, I would say, betting, or I would say gambling or something like that, because the exposure is very high and the risk is also very high. But at the same time, the options are not just used to make money, but it is used to hedge the positions as well. For example, I have taken 10,000 shares of Reliance Industries. Okay, my entire net worth is basically done in Reliance, for example. Okay, what if tomorrow I heard something bad about Reliance and my entire net worth goes to zero? I cannot let that happen to you, right? Or I cannot let, or I'm managing a portfolio for maybe Neil, I would say. I'm managing it for you. Tomorrow, what if Reliance goes bankrupt? His portfolio or his net worth basically becomes zero in that case. So I need to take a hedged position. So I'll take a hedged position with help of these forward futures, call option, put option, so that if in case it falls below a particular level, then also my loss is capped at a certain point. Okay. For example, my cap is 2%. So anything, even if the share price falls 4% or 5% in a particular day, okay, you will still expect that your overall net worth only falls by 2%. How do you manage that? How do you do that? You're going to learn it over the time. When you do 12 and 14, I'll really get into the level of details about, I would say, uh, like how do you do your hedging? How does your call options, what put options worth? I'll give you some real life examples as well based on a few trades. I'll just show it to you. How does that trade work? How does the graph works? I'll compare it with the assets so that you can visualize what is happening when you come to forwards, futures, call options, put options. Okay. That's around what we are going to do in your 12 and 14. It's one of the most important chapter. It's going to set your base for entire CM2. So try to be with me, especially even 1 to 4 is something I'm not very concerned about. Okay. It's an important chapter from your Excel perspective, not from your theory perspective. Theory perspective, you will hardly get around question of 5-7 marks tops. Okay. But in your Excel, there would be one definite question of 1 to 4 of around 30 marks. Usually 90% of the cases, there would be one question of your 30 marks. So in order to understand 1 to 4, you need to do theory, obviously. But it's easy. Similar to your 6, 7, 8, you will hardly have 5, 6 sum as doubts. Hardly. Okay, so it will go easier. Once you get into 12 and 14, things will get a little bit more difficult. So the month of June is a little bit more important, I would say. June and July, I would say. May, I'll keep it light so that since everyone is on break or whatever it is, you can manage it out. Please do 12, 14 pretty well before the next class, because we are going to really get into the examples and stuff. Considering today's scenario, what can we do? how do you make a profit, etc., etc., etc. So how do you do that is what we are going to learn in the 7 June class. So be with me for 20 seconds. Still, if you have not done a particular aspect, I'm still fine with that. But 7 June wala please karke aana. That would be my request. Okay. Okay. We were with respect to chapter 8 revision. Let's start with that. Okay. Notebook then on. Okay. Let's start with assumptions. The basic assumptions are with respect to 6, 7, 8. Can you tell me the assumptions which are not in 6, 7, 8 but is only applicable for chapter 8? Can you try, Neil? Only applicable to chapter 8, not with respect to any other chapters, okay? What do you mean by CFPM first? Can you please help me out with understanding that, Neil? Capital asset planning model. Okay, perfect. Okay, what are the assumptions only related to CFPM and not with respect to chapter 6, 7?
Investors have homogeneous expectations of risk and return.
Yep, investors have homogeneous expectation. Okay, why I'm asking you this? Because that would be a theory question which you'll be seeing in your revision notes where they have asked several times this questions. I'm just focusing on it, okay? Second one. Anyone? Borrow and lend money at risk-free rate. Third one.
Asset market is perfect.
Okay, let's just challenge these assumptions. We were challenging these assumptions when it comes to the 6, 7 chapters as well, like why these assumptions does not make logical sense. Okay, we try to do here as well. Homogeneous expectation, I guess it's pretty straightforward. No one has a homogeneous expectation when it comes to particular thing. But let's try with the second one. Borrow and lend at risk period. Do you think it's logical? No, right? Why? Yes? Yeah. Anyone else? Okay. So in real life, I would say this is usually measured with respect to your credit score. You might have heard about this concept. But I'll just explain it to you. How does your credit score works? Score is usually out of 800. Some calculation is done out of 900 also. There are different entities which does it. Crystal is one of them. You have standard and poor. You have Moody's. You have standard and poor. These are some rating agency which gives you rating. But on an individual level, it's basically with respect to your credit score. Okay, how do you measure your credit score? Is usually with respect to several parameters. The first one comes as your credit card. You have a credit card. Okay, for example, a limit of 1 lakh rupees is your limit. You spend 30,000 rupees. Okay, you pay it on time. Okay, your credit score will be around 750, 800, 750 out of 800. That's a good credit score to start with. As and when you pay it on time, this credit score will basically increase. That's one parameter they assess. The second parameter which they assess is nothing but your utilization. See, this 1 lakh is basically given based on your net income. Okay. It's usually 1.5 or 2 times as your net income to indulge you into more buying. Okay. But what example, if I'm earning 50,000 a month, I've been given 1 lakh of credit. If I utilize anything greater than 30%, that's considered to be very bad because you come under the name of risky person, that this person might default because he has such credit. He has such high credit that needs to be paid. So again, your score gets impacted. So they track it on a daily basis or a monthly basis. They do track it. You can even check your credit score through different portals. Okay. I guess your Paytm, your credit, every partner has now your credit score calculation. Even Money Control has it for a reason. I don't know why, but it has it. You can check it out. Higher the credit score, that means that you are more likely that you will pay your loans on time. If you're ready to pay your loans on time, for example, right now the risk-free rate in India is around 6%. Let's assume a credit risk or an inflation risk of 1% or 2%. So it's around 8% on an average, your risk-free rate. If your score is very good, you'll get it around 8%. If your score is bad, you'll get it around 9, 10, 11, 12, 13, 14, 15. In US, especially in US, I would say credit score is required every single place to get a job, even to buy a house, even to sometime rent a place as well. Okay, specific part of US do have that system, and I think it will soon follow in India as well. The only reason is, do you have enough money in order to pay your rent or even to pay your house loans? Or a person who does a job, for example, he does a job in some multinational company, let's assume JP Morgan. If he has a bad credit score, that means that he needs a lot of money in order to pay his debt. He can sell his company's secrets in exchange of money to pay his debts, right? That can be a scenario. That's the reason several multinational companies also check your credit score while hiring. This mostly happens in US, not in India. But yeah, your loan and everything requires your credit score. So higher your credit score, the better it is. For example, some big companies like I would just say Reliance Industries, they even get it at a rate of 3% or 4%. Okay. There are a lot of type of different loan also that comes into picture. That's your collateral loan, non-collateralized loan, and everything. But I'm not getting into that. That's not really important from your perspective, your exam perspective. But they might ask you to challenge these assumptions. That's why I'm just getting into the details because I don't think I've covered this in the lecture. Asset market is perfect. Large numbers of buyers and sellers, free entry and exit. This, I would say, is a good example of your Indian market. I feel it is, I would say, next to perfect. I wouldn't say 100% perfect, but it's next to perfect. You can buy and sell at any single point in time. I don't think so. There are always large numbers of buyers and sellers usually in a particular stock. So you do not face this problem. Okay. But if you see some bad, I would say, if you see some underdeveloped countries, then there might be certain problems as well. So when it comes to challenge, you can write it in a semi-developed or a developed country. It's not a problem, but in a also underdeveloped country, this can be a problem. Okay, that's around your CAPM. You might have studied a concept in your CS1. That's your regression. Okay, y is equal to alpha plus beta x. Can you give me one real life example of a regression? Yep, anyone? Yeah, both of them. CAPM and your SML is a part of regression. So now what I'm trying to do is, in this lecture, I'm trying to relate the concept of your regression with respect to CAPM and SML. We're trying to understand what the difference between CAPM and SML is. We just wrote the formula. Formula is self-explanatory, I know that. But we'll try to understand the difference. I'm just going to draw a plot. We'll try to understand the difference when and what is used, okay? I don't think so. This is even covered in textbook when it comes to when CAPM and SML is used, but I think you should know it. Okay, because they can definitely ask you the question because I don't trust IFO anymore now. I can say that for sure. Okay. Usually, how does a graphical representation look like? Uh, this is how a graphical representation look like. Devraj, can you tell me what would be in the x-axis? Ah, sleeping lines. Sigma P. And this is your expected return of your portfolio. Whenever, this is very important, okay, you will find your Excel sums related to this. Remember, sigma is always on the x-axis, y-axis is your expected return. This line, okay, is nothing but this is your risk-free rate. This is your curve, for example, okay. This portfolio, okay. This is your risk-free rate. This is your point. Can you tell me what does this point mean? That's the curve name. It's a market portfolio. It's tangent to your, I would say, your risk-free rate line or whatever it is. So this is based on your market. I would say, what was the term? What did you use for that? I sorry for that. Shit, I forgot the term. Market capitalization. Okay, what do you mean by market capitalization? For example, in a universe, there exist two assets, asset A, asset B. For example, asset A has around 1,000 shares listed on the stock exchange. B has around 2,000 shares listed on the stock exchange. A has a price of 10 rupees, B has a price of 20 rupees, for example. Okay. 1,000 into 10, this is known as nothing but your market capitalization. Numbers of shares into your share price is usually known as market capitalization. So in a universe of only two assets, their total worth is 50,000. So this would be around 20% and this would be around 80% on an average. So this point in a universe of only two assets, this point would be around 20% of asset A and 80% of asset B. That means that whatever amount you are investing in this ratio only, not in any other ratio, but this particular ratio only. That will be your point of market capitalization. This point, okay, or everything about this is nothing but I would say your efficient portfolios, right? All of these are efficient portfolios. You basically invest it, okay, when it comes to your risk appetite. Higher the risk, more return is what you're trying to seek. Now, if you're what does your CAPM and your SML assumes that you will be investing only based on market capitalization, not on the basis of a risk appetite. That means everyone is risk averse, okay? And they will basically try to maximize their return every single possible time. But in reality, it does not work, okay? In reality, always people try to, I would say, make more money or take risky bets. Forget everyone, even I do that. You have some positions in your risk, or I would say safe bet. Another position you just take. Gaya to gaya, nahi gaya to nahi gaya. Kind of a scenario. So everyone doesn't do that. So first of all, it does not make logical sense to follow this approach. CAPM SML is the worst, I would say the first investment tool in order to decide your investments. Is the worst tool. No one uses in reality, but these are just concepts which will build your base. Like a CS1, you understood distribution and then you went one step ahead, right? Every single point. You went into MLE, you went into confidence. Now you have more data, you can check more data, you can analyze more things, right? So this is just setting a base. Okay. So always you do in terms of market capitalization. Now, for example, there exists a C. C is nothing but, I would say, it is basically a government company which is zero risk and always gives a risk-free return every single time. Okay, it will be having zero risk. It has 1,000 shares. Okay, 1,000 shares with a price of 70 rupees. Okay, which comes out to be 70,000. Total comes out to be 1,10,000. 70 for 1,20,000. Right? The question is, do your market position really affect because of C government coming into or not? That means that my question is, does the proportion of A and B change or it does not change? Simple question. Why? Yep. You also told yours is not, right? Why? Simple question. Does not. See, it is there on the risk-free rate line only. It's there on the risk-free line. That means that this will have some proportion of risk-free and risky, right? Okay. Then why not? I'm asking you a question. Why C government would be considered as, or why it should be considered? They told it won't. And why not? Why won't it get considered? It's there on the line, right? No. Return has no relation with respect to any analysis which we are doing here. Do you want to change your answer to yes? You don't want to change your answer. Then justify it. You want to change your answer to yes? Then justify it. If you're not changing, then justify it, please. Yeah, that's the answer. It's actually at the point tangent to this curve. This curve only consists of your risky assets. Therefore, this point will only have risky assets. It was not this line you had to see, you had to see the curve. Curve consists of only risky assets, only risky. This is a combination of risky plus risk-free. So this means that this point is your risk-free. As and when you go up, that means you're increasing your proportion of your risky as compared to your risk-free. And this is the point where you're doing 100% risky, 0% risk-free. And if you're doing that in an efficient frontier or in your opportunity set, this will be based on your market capitalization only. Not any other possible option, only based on market capitalization. This is one of the assumptions. It's not explicitly written, but this is what you need to understand. In reality, no one does it based on market composition or market capitalization. People basically buy, sell. The share price fluctuates, automatically your market capitalization also fluctuates. Beyond this point, right? That means you short sell your risk free. Whatever money you get, you invest in risky. For example, I short sell 1 lakh rupees of risk free. That means in my account, I had 2 lakh rupees today. I short sell risk free asset. That means I got additional 1 lakh because I'm selling. Selling means I'm getting money into my pocket. That means I have 3 lakh rupees now. If I have 3 lakh rupees, I invest in stock market. Okay. For 1 year, whatever return I make, then I buy this. Then at a later point, I buy this. So for example, I made a 13% return. Here I have to give 1,07,000 because of the risk-free asset one. 7% is the interest rate, for example. That means that you made additional 5% by investing in the stock market, right? Before, because you were selling first, buying later, right? That's what happens beyond this point. Yes, people do take leverage risk. They do exist in the market. Okay, there are special funds. It's basically known as hedge funds. You might have heard this word very often. I want to work in a hedge fund. I want to work in a private equity. It's the most difficult space to enter in. For every 1 rupee, okay, for every 1 rupee invested by the investor, they take a position of 100 rupees. For every 1 rupee, they take a position of 100 rupees. That's 100 times the leverage of what you are investing. A percentage up and down basically changes your entire portfolio. Your money will vanish away just by 1% change. Just by 1% change. That's how people invest in a hedge fund. Hedge fund has a minimum buying till what I know of 100 crores. A good hedge fund has a minimum buying of 100 crores or maybe even 1,000 crores to be very honest. So these are your hedge funds. They invest, they have a leverage of 100 times and they basically take a risk. That's how your hedge fund basically works. Now let's compare the two securities. That's your CAPM, capital market line, or capital market line, and your security market line. Okay. Here What's the x-axis and y-axis? You're done, right? No, you're done. You're done. Yes. What's the x-axis, y-axis? And EP? This is your line, right? And this is nothing but your point, sigma of your market. Sigma of your market, we always assume it's 1. Or I would say covariance with respect to your market and your market, we always assume it's 1. Okay. Now, can you tell me the formula for capital market line, please? I just want the formula. I don't want the derivation. Okay. What does this mean? Can you explain what do you mean by market price of risk, please? What does the term mean? What do you see from the formula? What do you mean by it? No, not really. You want to try, Krisha? Just try to see the formula, try to understand what you are doing with respect to the formula, and try to make a logical sense. What do you mean by it? Yeah, that's what it means. Per, I would say, additional return per unit of risk. Okay. For example, your risk EM, I'll assume it to be 10%. Risk-free rate, I'm assuming it to be 3%. And your sigma of your market, I'm assuming to be 7%. That means that 10% minus 3% upon 7% is basically 7% upon 7%, which is 1%. That means for one standard deviation of risk, you're getting 1% return. Now, if the standard deviation of your portfolio, that's the portfolio you're holding, it's obviously not the market. The market is the entire thing, but you will have a limited stock out of the entire market. Let's assume that I am a risky person. I like to take big bets. I have a sigma P of, I would say, 30%. That means that I'm going to get per unit of risk, I was getting 1%. So for 30 unit of risk, I'll get 30% return. That's unit of risk apart from your risk-free rate. But obviously you're going to earn the risk-free rate only, right? You're going to run some additional risk-free rate as well. You're going to earn 30% plus 3%, that comes to 33%. That's what your return would be at the end of year 1. Based on your unit of risk, how much return you're making, and it goes on. Okay. I'll assume sigma of your market is, for example, 10%. That's what I'm assuming. Sigma of your portfolio is 7%. Now I'm telling you the market has a standard deviation of 10%. Sigma of your portfolio is 7%. Can you give me some stock price which will help me achieve that 7% return or 7% risk as compared to the market? Not you, Krishan. Some stock price which you think is below the risk of the market, and that will help you to achieve a 7% risk only. Can you give me some stock price name? You can give me and sector as well. I'm fine with that. Anyone? It's an open question for everyone now. Hmm? What? What does that company do? No, it's not bonds, it's stocks. We're talking only about stocks right now. We're not talking about bonds at the moment. The best example, just think of this way. During recession, which companies are going to be stable?
FMCG.
Yeah, the FMCG market. But again, in your FMCG, there is something known as Nykaa everything companies as well, which does not get considered here because Nykaa is kind of cosmetics. Cosmetics we assume to be a luxury product. But the basic necessity is what going to remain. That means your companies which is basically dealing in import and exports. agriculture-based companies. You have, I guess, Hindustan Unilever, uh, pharmaceutical, Sun Pharma, uh, Cipla. All of these companies are considered to be essential, right? Irrespective of the market, this will be going to be stable. So anything below your risky is going to be these kind of companies. Okay, that will basically reduce your risk as compared to the entire market. Above it, for example, now my sigma of my portfolio is 15%. What would be these stocks according to you? Energy? How come energy? And it's kind of an essential only, right? You're not going to live without energy. Yeah, you can, not exactly crypto, we are talking about equities. It's a different sector. See, understand this, okay? Uh, let me set the base first pretty right. So your markets, your entire investments is divided into various, I would say, asset class. The exact terminology is asset class. One asset class is your bond. Another asset class is your equity. Okay. Then comes derivatives. Then comes crypto. You can even give real estate as your asset class. Okay. Asset class basically indicate, okay, different areas in which you have an investment. These, if you see, have a different properties altogether. Okay. When I talk about equity, equity can be again further divided, okay, into your FMCG market. I would say defense stocks. You can give the name of, I would say, you can say railways. You can say telecommunication. There are 30 different categorization. FMCG is also again categorized into multiple aspects. For example, an MNC. MNC, for example, Amazon, which basically deals into all the type. It basically deals into consumer goods as well. It deals into luxury goods as well. You have, I would say, raw material companies, okay, but which deals in FMCG. For example, farmers, a group of farmers. I'll say Amul, for example. Amul is nothing but owned by farmers at the end of the day. They give milk, right? These are considered to be the raw materials of this. For example, just Amul was dealing in only the milk domain, not into the processed food domain. It will consider as a raw material, right? So even FMCG is divided into multiple aspects. Raw material, only dealing into processed food, only dealing into, I would say, MNC, which deals into everything, something only dealing into consumer goods, and so on. Your bond is also again further divided into categorization. One is known as your government bond, which is your risk-free bond. Okay. Then you have good types of bond, which is known as AA rating or AA rating or so on. You're going to study CM2, right? You're going to study this in chapter 19. You're going to study this in chapter 19. So every aspect is divided into multiple aspects. Your shares is a part of your equity. So here your chapter 6, 7, 8 majorly talks about bond being the risk-free rate, which will give you the risk-free rate. But we are mostly talking about the investment when it comes to equity portfolio only. So the portfolio, which is basically considered to be very risky, is basically considered to be equity. Luxury products, you have, I would say, hotel industry, you have service industry, for example, IT companies and everything. Uh, then you have, I would say, what are the luxury products? Flights, Indigo, Go Air. All these are considered to be luxury. In case an economic crisis happens in India, people are going to save money by traveling in maybe trains or somewhat like that, rather than going in a car or maybe going in a flight or an aeroplane. Okay. For example, but that's kind of a necessity, right? You might, but share story na hai. These are commodities. Not exactly. Not exactly. In a particular season, you're going to consume, you'll consume less, obviously, but you're going to consume at the end of the day. So that's how your overall analysis is done. So anything above your risk-free rate, the return you're getting per unit of risk is basically your market price of risk. Market price of risk per unit of risk, how much return you're making. You're multiplying it with respect to sigma of your portfolio. That means in your entire portfolio, how your sigma basically differs. I'm a risky person, my risk is higher, so obviously I am entitled to more return, right? That's how you basically analyze it. Okay. So this concept is majorly used in calculating the expected return overall you're expecting in a share. There are multiple ways to calculate it. Okay. But this is one of the method, I would say. Your CM. Okay. Let's talk about the second aspect. That's your SMN. Security market line. Okay. Krisha, can you tell me what's on the x-axis and the y-axis? Okay. Again, this would be your point. Can you tell me the formula? Expected return of portfolio is? Can you tell me what is the formula for beta P? Where your beta P is equal to? Upon? Yeah. So if I just input this formula here, this would be EM minus RF upon VM. Okay. Into covariance of RI, comma RM plus RF. What is covariance of Ri, comma Rm? Can I just write it is nothing but correlation of your I with M into sigma I into sigma M. Covariance writing in the form of correlation. Okay, nothing else is what nothing else I'm doing. Can I just cut this and write sigma M? So can I say this is EM minus RF upon sigma M into correlation of IM into sigma I plus RF? This is nothing but I would say your security market line. But if you see the formula of your capital market line as well. Okay. Now, if you compare it, can I say these two aspects are exactly the same? The only difference is instead of sigma P, you have correlation and sigma plus your risk-free rate. Now, when I'm talking about comparing these two, okay. Now, from this formula, okay, see the only difference is this and this. Carefully see these differences. Can you tell me in which scenario will you use a security market line? In which scenario you will use a capital market line? This is your security market line. This is your capital market line. In which scenario will you use your security? Which scenario you use a capital market line? That's what the question is now. Open to anyone who wants to give it a try. That's the reason. So if you carefully see, here we always talk about portfolio. Here we talk about an individual asset. Okay. There are properties with respect to sigma and your, I would say beta. Beta as a risk measure is only used for comparing one asset class or one asset with respect to your market. But your standard deviation compares your entire portfolio with respect to your market. With respect to market. Because of the property of your sigma and your beta, I would say that your sigma is used for your entire portfolio. Standard deviation is usually used for entire portfolio. Beta, your correlation and your standard deviation is only used for your single asset case. Okay. Yep. Most of the time, they will tell you with respect to chapter 8, all the proofs are important. All the proofs are very important. That's one thing. Prove, derive security market line, derive capital market line. Formulas are very important when it comes to your chapter 8. That's your security market line and capital market line. They'll tell you to calculate the expected return. Or else they will tell you, I do not have a correlation, but I have everything else. Try to find me a return for it. That's the second type of question which will come. The third type of question will come with respect to market capitalization. Market capitalization, if you remember, this was market capitalization. What did we do? Shares, number of shares into your share price. This is your value. Okay. Now, for example, this is weightage is 20% and 80% respectively. This earned 7% return, this earned 6% return. You calculate the expected return of your entire portfolio, variance of your entire portfolio. This is the third type of question which comes to chapter 8. And finally, all the theory aspect. That means assumptions, why the assumptions are bad. Security market line, when will it get used and what is the rationale behind it, as well as the capital market line. These are the four areas the question will be tested when it comes to chapter 8. With this, you are done with overall revision of your chapter 8. You can just go through the entire 6, 7, 8 right now. If you have any questions, you can let me know while reading the textbook or anything. Whatever you have, you can let me know. If not, then I'll start with your doubts with respect to your sum solving, what you have done. You can read the textbook except for chapter 9 to 11, 15 to 19. Except for these chapters, you can read the textbook. Make sense? Your CM2 textbook of 2019 is exactly the same. The only difference in chapter 9, they have added one section. Chapter 5 and chapter 3 has been omitted. Everything else remain as it is, not a change in the word as well. मैं ऐप पे डाल दूंगा अभी वहां पे सब अपलोड कर वहां पे पूछ लेना ना डिड यू लॉग इन वाया ओटीपी नीचे ऑप्शन है लॉग इन वाया ओटीपी you write your email id they will give you a pop up of an otp just otp automatically screen पे validate आ जाएगा click on validate it will take 5 minutes automatic सब आ जाएगा you don't have to even put the key id no that's what I'm doing now. I'll give you the downloaded version of this booklet वहां पे downloaded होगा you can download it there makes sense done can I start with questions Oh. Any doubts in chapter 6 text back? Anyone? Which one? Got it. Third one, using mean value prove that the efficient frontier becomes a straight line in presence of a risk-free asset. Okay, cool. Anything apart from this? Hence, the equation of the new is expected return standard deviation space. Okay, it's easy one only. Also, sixth one, entire question. Derive for the portfolio the expected return in the proportion of x1 and the point of global minimums. Comment briefly on EX1 with respect to your role. Okay, cool. First you have to show that it becomes a straight line in presence of a risk-free asset. For example, let's consider asset A, asset B. Asset A is considered to be risk-free. Asset B is considered to be a risky asset. Okay, let's consider it any asset. We don't care about it. We have to show that the efficient frontier becomes a straight line in presence of your risk-free, this one. So if you remember, your x-axis was nothing but your VP, and this was nothing but expected return of your portfolio, right? So if I derive an equation in the format of VP and EP, can I basically get a relationship between VP and EP? If it becomes a straight line, then it makes logical sense to me. That's what I'm trying to do. Okay. So what is the basic formula for VP? It's nothing but XA square VA plus XB square VB plus 2XA XB covariance of AB, right? Now, can I say variance of A would be 0 because it's a risk-free asset? Covariance will also be 0 between A and B, risk-free and risky. There's no correlation, right? So your VP, can I say is nothing but XB square VB? Or I can say sigma of your portfolio is nothing but XA into sigma B. Can I say that? Now, expected return. Expected return is nothing but XAEA plus XBEB, right? From this equation, sigma B. So can I say from this equation, XB is nothing but sigma P upon sigma B? Can I substitute it here? Right? So I will say that XAEA, just trying to establish a relationship between VP and EP in the same line of equation, okay? So can I say this would be nothing but simply XAEA plus sigma P upon sigma B into EB is nothing but expected return of your portfolio. Can I say that? XA is nothing but XA is 1 minus XB, or can I say 1 minus sigma P upon sigma B into EA plus sigma P upon sigma B into EB. Let's try to common the denominator. Denominator would be sigma B. This would be EA minus EA into sigma P plus sigma P into EB. right? I can say that. Okay. EPP, this is expected return of your portfolio. This is whole divided by sigma B. Is there a way I can simplify this better?
I think first term will also multiply it by sigma b. EA into sigma b. The first in the numerator.
EA कहाँ पे है?
First
हाँ,
term.
EA into sigma B, that's fine. I'm thinking if we can represent this in, okay, what I'll do is I'll just keep this as it is. Can I write this in the format of XB and then substitute XB here? That would be a little bit simpler to read. Let's try that. Can I say XB is nothing but EP minus XAEA. XAEA is nothing but risk-free return. The risk-free return, whatever you're going to earn, okay, upon your expected return of your B asset. Can I say that? Or you can just write it XAEA also. I'm fine with that. If I substitute this here in this equation, okay, I'll get sigma P is equal to XB into sigma B. Instead of XB, can I just write EP minus XAEA upon EB into your sigma of your B. See, this would be some percentage return. This would be a percentage return. This is a percentage return. This is nothing but the proportion. So this will entire be a constant value. Or let's assume XA is not a constant value. We are trying to move XA. This would be a constant value in this case because this would be previously known to you because the assumption states that you have homogeneous expectation with respect to your A and B. Now, if you see everything is a constant except for A. So if your A increases, for example, your sigma P would decrease, right? If your A, your XA basically decreases, your sigma P will increases, right? And if you see your standard deviation, this is nothing but a constant value depending upon your asset return. So don't you think this nothing but looks like your, I would say, uh, your linear regression? Why this is a linear regression, I will tell you. Sigma P is equal to, let's assume XA is a constant. So everything else constant, okay, is nothing but Y is equal to MX plus C. Constant value is not here. X value, the random variableness is your XA, everything else is nothing but your M. So isn't this forming nothing but an equation of your linear regression but without a constant? What is a linear regression at the end of the day? A straight line, right? So ho gaya, straight line. Or else if you don't want to get more complicated, you can also state by this point only. Sigma P is nothing but XB into sigma B. Sigma B would be known to us. As your XB increases, it linearly increases your volatility of your portfolio. If your XB increases, the volatility linearly increases. And your expected return also linearly increases as your X and XB changes. So at the end of the day, with these two statements also, you could have told that it's nothing but a linear regression. There are multiple ways to represent the same answer. You can follow any of these. That's 4.3. Okay. 4.5, fourth one. Okay. Yes, what happened here? Yeah, I'll just open the solution. Yes, bolo. This is XA, XB is your, right?
Yeah.
So you got the proportion. You calculate the expected return. Expected return of your XA, EA, that's your E. This is nothing but your standard deviation. And this is your final formula. This formula whenever there exists a risk-free asset, then it will always be a straight line. It will always be a straight line. I'll just show it to you. We did this analysis right here. This is the formula which they are using. If you carefully see, yep, EM minus RF upon sigma M into sigma P. EM is nothing but return of your risky assets. Risk-free assets is nothing, risk-free is nothing but the rate. Sigma of your market is nothing but standard deviation of the market. This is your portfolio plus your risk-free rate. This will also be always a straight line. This is an example of your linear regression, as I told you earlier. And this matches the portfolio concept also what you're trying to do. So your A and B is your portfolio. So wherever your sigma P, EP is there, you'll write your portfolio return. EM sigma M would be your market return. And thus it will always be a straight line because it's an example of a linear regression. Always. You just substitute in the formula, you'll get the new efficient frontier. That's it. Always, always, always. The security market line, if in presence of a risk-free asset, even if it's one security or multiple securities, always be a straight line because of your concept of your SML and CML. If you, I started with that only, an example of linear regression because it's a straight line. 4.6 second on. First derivative, put it as equal to 0, whatever equation you get, and then you check the relationship between them. Yeah, what happened here? Yeah. Rho. This one. So rho, okay. If it's a positive, see rho can take a value from -1 to 1. Okay. And they have told you it's a negatively correlated, right? Ki correlation kya kuch bola? Okay. So here, if you want to, rho will always take a value from -1 to 1. If you want to maximize your expected return. What do you mean by derivative in the first place? Derivative basically means change with respect to rho in your expected return. So you want to maximize the change, right? In order for you to maximize, denominator will be a positive value. For example, if I take a rho as value of 1, it will be 1 square. If I take value of 0.5, it will be maybe also 0.42, 3 square, and so on. As the value of rho is greater than 0, your denominator decreases. Sorry, denominator increases. Can I say that? Your change in the value, that means the negative value increases. Let's take an example. For example, rho is equal to 1. This value will become -30 upon 5 minus 4 square. That's 1 square 1. That's -30 as a change. If rho is 0.5, it will be 0.5 into 4. That's 2. 5 minus 2 is 3. 3 square is 9. So -30 upon 9 is equal to minus whatever it is. 3 point something, whatever it is. I don't really matter. This means that whenever your rho is, as and when the rho gets lower, your change decreases. change is a negative change. So the lowest negative change will give you the best possible outcome. You agree with me? The lowest negative change will give me the best possible outcome. So do you see that it is decreasing? So if I take a negative value, for example, -1 now, this will become +1, 9 square, 81. So -30 upon 81 is very small. So you want to basically increase your correlation to 1 in order to ensure that you get the maximum return overall, right? Maximize your return. The change you have to decrease is in order to maximize the return, right? Similar thing with X1 as well. They have also written the same conclusion. If you see, this is negative. The portfolio expected return at the point of minimum global variance decreases as the correlation coefficient increases. Similar concept with here as well. Your proportion invested, okay, will basically the portfolio proportion invested in security one at the point of minimum global variance increases as the correlation with the correlation coefficient. They have just inputted the value of -1 and 0 and 1. So if it's -1, your E is 6.2%. If it's 0 is 6% and it's 1 is 0%. They have just inputted the value and showed to you what happened. This line is actually not very useful. They have just substituted it here and just tried to get the values. That's it. Because you wanted to comment on the minimum global variance and your expected return in X1 with respect to rho. So that was the objective. So we met the objective. You can skip that line if you want to. Okay, done with chapter 6. Commenting among there. Simple. Yep, chapter 7. I don't think so इसमें doubt होगा. Unlikely. नहीं होगा. 5.5. 5.5, especially the fourth part. I know that. Everyone will have this 5.5 fourth part. Okay, I'll solve this. This is a very tricky one. So try to be with me, okay? Okay. I need to see the solution because I need the prior results as well in this question. I'm doing in a different way as compared to what question has been given us. So, okay, we'll try it out. 5.5. See, what they have given is beta, this is sigma p square is summation of xij, xj, cij. And your covariance of IP is nothing but xj, summation of xj and cij. I'll just write this statement down here somewhere so that we can see. Wait, I'll just have that solution open with me. If you want to close the fan, you can close the fan as well. Okay, you derived in your part 2 that covariance of I with respect to portfolio is nothing but summation of xj, cij. That's you derived in part 2. Okay. Part 3. Okay, you told that your sigma p square is equal to summation of I equal to 1 to n, summation of j equal to 1 to n, xi, xj, cij. Now let's start part 4. Okay. Part 4 is, what's the question? You have to show from the results of part 2 and 3 that beta ip is equal to change with respect to your standard deviation with respect to xi into 1 upon sigma p. Okay. So first we'll write VP. VP is nothing but x1 square V1 plus x2 square V2 plus 2x1 x2 C12. Okay. Now I'll do D of, what do they want is D of sigma P they want. D of sigma P they want. Okay. What will I do is x1 square V1. If I not two. Chalo na, let's take an example of two asset case first. Okay, let's take sigma P. What is sigma P? Root of x1 square V1 plus x2 square V2 plus 2x1 x2 C12. Now I do D of sigma P upon D of xi. So this will be nothing but raised to half. So half of, I would say, x1 square V1 plus x2 square V2 plus 2x1 x2 C12. Okay, raised to minus half into, according to the chain rule, this would be nothing but 2 times x1 V1 plus 2 x2 C12. I did it with respect to x1. Okay, just one. I did it with respect to x1. Okay. Can I write this as nothing but VP? This is VP only, right? Can I say half of VP raised to minus half? Or can I say half of 1 upon sigma P? Okay, multiplied by 2x1 V1 plus 2x2 C12. Can I say this? Right? What I have to show is, I have to show that beta IP is D of sigma P upon xi into 1 upon sigma P. That's what I have to show. What is the basic formula of beta IP? What's the formula for beta IP? No, you have calculated this in part 1. Wait, I'll just share it with you. Wait 1 second. Okay. That's okay. This way. If I were to do sigma P square, this is D of sigma P. If I were to do this sigma P square with respect to, I would say xi, with respect to xi, I can just write it as 2 sigma P into D of sigma P upon D of xi, right? Can I say this? Now, what is this value? This value is nothing but what we calculated here, right? This is the value what we calculated here. Can I just substitute it here? This equation, can I substitute it here? This will be 2 times sigma P into 1 upon 2 into 1 upon sigma P, 2x1 V1 plus 2x2 C12. This and this gets cancelled. So this will nothing be equal to 2x1 V1 plus 2x2 C12. So in short, can I say I have to just prove this one, then my basic equation condition will basically meet. If I prove this one, this is true, then my condition will meet. Let's take with respect to an example now. Okay. 1, 2, 1, 2, 1, 2. So you have V1, you have V1. You have x1 square V1, you have x1 square V1. You have x1, x2 V12. You have x1, x2 V12. This is nothing but your basic variance formula, right? in your 2 asset case. So if I were to write this in a 2 asset case, can I say this is nothing but 2 times? This is nothing but, I would say, x1 square v1 plus 2 times x1 x2 c12. Now, if I try to differentiate this with respect to x1, what I'm doing is sigma p square with respect to x1. Doesn't this give me the same answer as this one? So can I say for the 2 asset case it is matching, for then all asset case it will match? For n asset case also it will match? What did I try to do is simply, first I differentiated sigma p asset. I got this weird equation. I showed that if I do variance ka differentiated with respect to x1, I'll have to get this equation. If this is getting, then I'm right. And I showed with respect to one example that this is getting matched every single time. So it matches. So can I just say this value is equal to this value, hence proved? Can I say that? Yes, no? कि bouncer जा रहा है. जा रहा है bouncer? Yes, no? It's fine. Bouncer? मामा इसका recorded lecture है ना अपने पास? मैंने दिया था तुम लोग का इसका. Let me check. I have it mostly or not. ठीक है, तो फिर मैं ये अभी नहीं करता हूँ. I have the recorded lecture mostly. मैं वहाँ पे दे दूंगा. So it's easier for you to recall अभी कौन सा जा रहा है तो. Yeah, I solved this question entire in 11 minutes. You can see that. That would be easier. अगर ये नहीं देखना है तो वो देख लो चलेगा. अभी नहीं समझ रहा तो. I don't want to push it out. It is uploaded on the app. 90% it is uploaded on the app. You can check it out later. That's fine. ठीक है, next question पे ही जाता है तो फिर. Any other question with respect to chapter 7 which you didn't understand? You can see this in the recorded format. That's fine. मेरा solution वो वाला देखना ज़्यादा easy है, but I'll just show it to you. I'll just explain you one step also if you want me to. Yes, बोलो. Which one? This one? No. Differentiating the left-hand side of the equation. That's the formula which we wrote. अपन ने अभी एक example लिया if you saw. If I took that 2 asset case as an example here as well, 2 times x2 c12, this is what we got if you remember, plus I can say क्या था, what did we get? 2 times x1 v1, 2 times x1 v1. What is x1 v1? It's nothing but c11 only. Now if you carefully see, 2xi cii is nothing but 2x1 c11. This one is this. I proved. You have to show it as an example. For 2 asset case, it is matching. Therefore, it will match for all the n asset cases. That's how you have to do. That's why I did the 2 asset case right now. But some bouncer तुम लोग को ज्यादा था. That's why I stopped it right here. Perfect. ठीक है, you can see the recorded one. It's much simpler, I feel. थोड़ा वो ज्यादा you can, because you can go back and go front, it will be a little bit easier for you. You can see that for sure. कितना बजा 4 o'clock ना? Chapter 8. Chapter 8. Any questions? Solve किया है कि नहीं किया तुम लोग ने? क्यों? You just told the last 10 questions are remaining. So that the security market line can be arranged to give an expression in the form of, okay. Huh. We just did right now only. I'll just show you the solution. You will be able to recall it. But I'll just show it to you. See what they have denoted as. See, अपन ने यहाँ पे ही proof किया when I was explaining you the concept. We were comparing, if you remember. So this is your security market line. I wrote in the form of market price of risk, right? बस वही है. It's the exact this proof. This proof what we did right now. ठीक है? Okay, wait, I'll open the solution if you're referring to somewhat. Point. Which one? 1 or A or B? Okay, what happened here? A1 में. This you are not able to understand. See, for you need to derive betas from market portfolio. Market portfolio will give you expected return of your market is equal to risk-free rate. I'm just using this formula, EM minus RF into beta M. Huh. EM minus RF will get cancelled off. So your beta M is equal to 1. So this you understood the logic. I just, instead of portfolio, I wrote it M because market is now your portfolio. So this would be EM minus RF is equal to EM minus RF into beta M. This and this gets cancelled. So your beta M is equal to 1. That's what you proved. छोड़ा ना, मैंने समझा ना. Genuinely, did you understand mine? What did I do? Then it's okay. Doesn't make a difference. Then what happened? And for the risk-free asset, right? The risk-free asset, your return would be also risk-free. So R is equal to R plus EM minus R into beta of R. So R and R goes to 0. Yep. So automatically, can I say your overall this, I'll go to this side. So this will get divided. So beta R will be equal to 0. Oh yeah. Done? Do you want me to do assignment or next time? Yes. 1.5 घंटा नहीं हुआ तुम लोग को next time करना है. And half. We started at 2:30. You want to do it next time? 20 seconds. 20 seconds. कर लेना 10-15 sums. ऐसे तो बैग पैक करके रेडी जा लेंगे मुझे सब. Do you want to do 10-15 sums or next time? कैसे लोग हो यार. चलो next time और क्या? Your wish. Chalo, that's it for the day.